I want you to do something right now. Find your most recent pay stub. It might be in your email. It might be in a company benefits portal you log into twice a year. It might be a paper copy folded into a drawer you haven't opened since the week you started this job. Wherever it is, find it. Now look at it. Not at the bottom number, not at the net pay figure you check every payday to confirm the deposit landed. I want you to look at the column above it, the deductions, the itemized list of every dollar that left your gross pay before it ever reached your bank account. Most pay stubs have between 8 and 15 line items in that column. Federal withholding, state withholding, Social Security, Medicare, health insurance premium, dental, vision, life insurance, 401k. And somewhere in that list, on approximately 58 million American pay stubs, according to the Employee Benefit Research Institute, there is a line that says something like HSA or health savings or HSA Pretax. That line is what I want to talk about today. Not because it's the largest number on your pay stub, it isn't. Not because it's the most complicated, it isn't that either. I want to talk about it because the gap between what most people think that line means and what it actually means, in real dollars, compounding over a working career, comes out to approximately $60,000. $60,000. Not from a raise, not from a side business, not from a stock you picked, from a line on a document you receive every 2 weeks. A line most people glance at, recognize, and immediately move past. Let me show you exactly how this works. Before I introduce the number, I need to establish something that changes the rest of this video. Most people who have an HSA describe it to me the same way. It's the medical savings thing. The money that comes out of your check and goes onto a card you swipe at the pharmacy. You put money in, you use it for co-pays and prescriptions, and whatever's left rolls over or disappears depending on how you read the documentation. A medical account. Useful vaguely in the way that knowing your dentist's name is useful. Present. Not particularly interesting. That description is technically accurate. It is also approximately as complete as describing a 401k as the thing that takes money out of your paycheck on Fridays. An HSA, health savings account, is in the language of the IRS tax code a triple tax advantage savings vehicle. 3 separate tax advantages, stacked, simultaneously, operating on the same dollars. Let me break each one down, because the 3 together are what create the $60,000. Tax Advantage 1, contributions are pre-tax, not just income tax pre-tax, FICA pre-tax. When you contribute to your HSA through payroll deduction, those dollars come out before federal income tax, before state income tax in most states, and before Social Security and Medicare taxes, what the IRS calls FICA. That is the only personal savings vehicle in the United States tax code that avoids all 3 simultaneously. A 401k contribution saves you income tax, but not FICA. A Roth IRA saves you nothing on the front end. An HSA through payroll deduction saves you all 3. At $3,000 in annual contributions in the 22% federal bracket, that pre-tax advantage translates to approximately $664 in federal income tax savings, plus an additional $229 in FICA savings. That's $893 back in your pocket in year 1 alone before a single dollar of investment growth has occurred. An effective 30-cent discount on every dollar entering the account. Tax Advantage 2, tax-free growth, money invested inside an HSA, and I'll come back to the word invested in a moment because it's doing significant structural work in this sentence, grows completely free of capital gains, tax, dividend tax, and interest income tax. No 1099 arrives in January. No annual tax event, no drag on returns. The gains accumulate silently, tax sheltered for as long as the money remains inside the account. For comparison, money in a taxable brokerage account growing at 7% gross is actually growing at closer to 5.7% to 5.9% net of taxes, depending on your bracket and the character of the gains. Over 30 years, that drag compounds into a significant difference. The HSA eliminates it entirely. Tax Advantage 3, tax-free withdrawals for qualified medical expenses. The The IRS maintains a list of qualifying expenses. It's longer than most people realize. Prescriptions, copays, deductibles, dental care, vision care, orthodontics, hearing aids, long-term care insurance premiums, COBRA, continuation premiums, certain over-the-counter medications, mental health services, and hundreds of other categories. When you pay for any of these with HSA funds, you pay no tax on the withdrawal. The money entered the account tax-free. It grew tax-free. It exits tax-free. The effective tax rate on those dollars from the moment they left your paycheck to the moment they paid your optometrist is zero. No other account structure available to individuals in the United States does all three. Not a 401k, not a Roth IRA, not a 529, not a traditional IRA, nothing. The HSA is the single most tax-efficient savings structure in the code, and the majority of people who have access to one are treating it as a medical debit card. Now here is where the $60,000 lives. Inside every HSA account at every major administrator, Health Equity, Optum, Fidelity, HSA Bank, Further, Lively, there is an investment feature. A mechanism that allows you to take your HSA balance and invest it in mutual funds and index funds, identically to how you invest inside a 401k or brokerage account. Most people have never seen this feature. Most people have never been told it exists. Most people with HSAs have their entire balance sitting in a cash position, a savings account, earning somewhere between 0.1% and 0.7% annual interest depending on the administrator, the year, and the current interest rate environment. I want you to meet two people. Their names are Arthur and Marcus. They work for the same company. They are enrolled in the same health plan, an HDHP, a high deductible health plan, which I'll explain fully in a moment. They use the same HSA administrator, Health Equity, one of the three largest HSA custodians in the country, holding approximately $19 billion in HSA assets across roughly 14 million accounts. Both of them have the same line on their pay stubs. HSA Pretax, $250, $250 per paycheck, twice a month, $3,000 per year flowing into their HSAs. They both opened their HSAs in January 2005. It is now January 2025. 20 years later, here's what each of them did. Arthur, in March of 2006, 14 months after opening the account, was logged into the Health Equity portal for an unrelated reason. He was updating his mailing address. While he was in there, he noticed a tab he'd never clicked on. It was labeled Invest. He clicked it. What he found was a list of mutual funds, index funds, target date funds, bond funds, a menu similar to what you'd see inside a 401k investment election page. He could invest any portion of his HSA balance above a minimum cash threshold of $500. He scrolled through the list and found a total market index fund with an expense ratio of 0.04%. He set his threshold to $500. He selected the index fund. He clicked a toggle labeled Auto Invest that would automatically sweep any balance above $500 into the fund each business day. He confirmed his selections. 14 minutes, one time. He did not think about it again for years. Marcus never logged back into the Health Equity portal after the initial account setup. He checked his balance occasionally, usually when he had a large bill and wanted to confirm the funds were available. He used the HSA the way it was presented to him at new hire orientation as a medical expense fund. He contributed. He spent when he needed to. Whatever balance accumulated sat where Health Equity put it when he opened the account in the default cash position, earning the default interest rate. He was responsible with it. He used it for the right things. He appreciated having it. He just never clicked the tab that said Invest. Here is what 20 years produced. Arthur's $3,000 per year, invested in a total market index fund averaging approximately 7% net annual return, 123,400 shares. Marcus's $3,000 per year, sitting in the Health Equity default cash position, averaging approximately 0.5% annual interest, $63,200. Same $3,000 per year, same 20 years, same account type, Same administrator, $6 to $200 difference. Arthur has $60,000 more than Marcus in an account where every dollar of that difference is completely tax-free. No capital gains tax owed, no dividend taxes accumulated, no annual reporting. Marcus has been unknowingly transferring the return on his own money, $60,000 of it, to the institution holding his account. Health Equity was investing that cash balance at market rates and earning the spread. Marcus was earning 0.5%. They were earning 4%, 5%, sometimes more. The difference belonged to them. It was in the terms he accepted when he opened the account. Page 14, paragraph 3. I want to pause here and explain why this structure exists, because I think understanding the business model makes you significantly less likely to participate in it involuntarily. HSA administrators earn what the industry calls float income. When your HSA balance sits in cash, the administrator deposits it in FDIC-insured institutional accounts or short-term government securities and earns the prevailing rate. In 2024, that rate was approximately 4.8% to 5.25%. They pay you 0%. They retain the difference. Health Equity disclosed in their fiscal year 2024 10K filing, publicly available on the SEC website, that they generated approximately $268 million in custodial revenue from interest income on deposited cash balances. That number represents the aggregate float they earned on the cash sitting in accounts like Marcus's across 14 million account holders. This is not illegal. It is not hidden. Technically, it is disclosed in the account terms. It is a business model, and it is a perfectly functional business model as long as account holders don't click the Invest tab. Their financial incentive is for your balance to remain in cash. When your money moves into an investment fund, Health Equity earns a smaller revenue stream, investment management fees rather than float income. Float income is more reliable, higher margin, and doesn't require you to do anything. The investment feature sits behind a secondary tab because that is the least visible, least frictionless place to put something you don't want everyone to use. This is not a conspiracy. Nobody is plotting against you. It is a system optimized for institutional revenue, and it runs on your inattention. Now I want to show you what happens when you take this further than just turning on the investment switch, because $60,000 is what the switch is worth. It is not the ceiling of what the HSA offers. There is a strategy that a small number of disciplined people use to convert the HSA into one of the most powerful retirement accounts available. It is legal, documented, and entirely within the rules the IRS has set. The financial planning community calls it receipts banking. I call it the stealth IRA. The structure is this: you contribute the maximum to your HSA each year. For 2025, that's $4,550 for individual coverage or $8,300 for family coverage. You invest everything above the minimum cash threshold in a low-cost index fund. When you have a medical expense, a copay, a dental bill, a prescription, anything on the IRS qualified expense list, you pay for it out of your regular income. You do not touch the HSA, and you save the receipt. Here is the rule the IRS has established that makes this work. There is no time limit on HSA reimbursement. You are not required to reimburse yourself for a medical expense in the year it occurred, or in the following year, or within any defined window. You can pay a $300 dental bill in 2025, save the explanation of benefits your insurer sends you, and reimburse yourself from the HSA in 2045. The only requirements are that the expense occurred after the HSA was opened and that you have documentation. What this produces over time: your HSA becomes a permanently invested, fully tax-free account that compounds for decades, while you accumulate a growing inventory of unreimbursed medical receipts, receipts that represent documented, IRS-validated withdrawal rights you can exercise at any point in the future. The account and the receipt inventory grow simultaneously. The longer you wait to exercise the receipts, the more your invested balance has compounded. If you are 35 years old and you max your individual HSA at $4,950 per year for the next 30 years and invest at 7% average annual return, your balance at 65 is approximately $416,000. Every dollar of documented medical expense you paid out of pocket during those 30 years represents a dollar you can withdraw from that $416,000 completely tax-free. After age 65, the rules expand further. HSA funds can be withdrawn for any purpose, medical or otherwise. Non-medical withdrawals after 65 are taxed as ordinary income, the same tax treatment as a traditional IRA distribution. There is no additional penalty, which means your HSA after age 65 behaves exactly like a traditional IRA, with one permanent exception: documented medical expenses still exit completely tax-free. You end up with 2 withdrawal channels simultaneously available in retirement, tax-free for anything on the medical expense list, taxed as ordinary income for everything else. No other personal savings account offers both channels from the same pool of assets. Now I need to address the requirement that makes HSA access conditional, because there is one, and I won't skip it. To contribute to an HSA, you must be enrolled in a qualifying high-deductible health plan. The IRS definition for 2025, a minimum individual deductible of $1,650 or a minimum family deductible of $3,300 with maximum out-of-pocket limits of $8,300 and $1,600 respectively. If you are currently enrolled in a traditional PPO or HMO, you cannot contribute to an HSA under that coverage. This is a hard rule. But here is the question worth running numbers on before your next open enrollment window, particularly if you are generally healthy and your year-to-year medical costs are predictable. What is the annual premium difference between your current plan and the HDHP your employer offers? For most employer-sponsored health plans, the HDHP carries a meaningfully lower monthly premium than the PPO option. If the annual premium savings from switching, the money you stop paying in monthly premiums, is greater than the difference in out-of-pocket exposure you're likely to face in a typical year, the HDHP produces a better financial outcome before you account for the HSA benefit at all. When you add the triple tax advantage of the HSA, the comparison shifts significantly further. I'm not going to tell you that the HDHP is always the right choice, because it isn't. If you have a family with chronic health conditions, predictably high medical utilization, or significant prescription costs, the higher deductible can produce worse outcomes than the PPO despite the premium savings. The math depends on your actual utilization pattern. Run your numbers from the last 2 or 3 years before making this decision. What I will tell you is this: if you are currently enrolled in an HDHP, have an HSA, and have been using it as a medical debit card, the qualification question is already settled. You are eligible. The investment switch is already inside your portal. The feature exists. You just haven't clicked it. Let me show you the complete number, the combined effect of everything I've described, because I think the 3 advantages presented separately understate the total impact. You are 35 years old. During open enrollment, you switch to your employer's HDHP. Your monthly premium drops by $150 compared to your PPO, $1,800 per year in premium savings. You redirect those savings into your HSA, and you contribute an additional $200 on top to reach the $3,000 annual contribution level. You invest the balance above $500 in a total market index fund. You pay medical expenses out of pocket and save receipts. You do this for 20 years. Your HSA balance, $123,400. Your accumulated medical receipts at $2,000 per year out of pocket. $40,000 in documented tax-free withdrawal rights. Total tax-advantaged assets connected to this account, approximately $163,400. Now compare the person who stayed on the PPO and invested the equivalent $3,000 per year in a taxable brokerage account, growing at 7% gross, but taxed annually at their effective rate, approximately 5.9% net, $99,000 after 20 years. Same $3,000 per year. Same 20-year period. $163,400 versus $99,000, and the $163,400 account still carries the tax-free withdrawal rights. The taxable account does not. The line on your pay stub that says HSA is not a minor benefit. Here is what I want you to do before the end of this week. Step 1. Open your most recent pay stub and find the HSA line. If it's there, you have an HSA. Stop reading and go to your administrator's portal, not your company's benefits portal, the actual HSA administrator's website. Log in. Step 2. Look for a tab or menu item labeled Invest, Investments, Investment Account, or Market Funds. It will not be on the main dashboard. It is typically behind a secondary navigation tab. Find it. Step 3. Set your investment threshold to the minimum allowed, typically $500. Step 4. Select a fund. Look for a total market index fund or S&P 500 index fund with an expense ratio under 0.15%. Avoid the target date funds on HSA platforms. Their expense ratios are often 0.5% to 0.8%, which eliminates a meaningful portion of the tax advantage over time. Step 5. Enable Auto Invest. This is a toggle that automatically sweeps new contributions above the threshold into your selected fund without requiring you to log in each time. Enable it. Confirm it's active. This process takes between 10 and 25 minutes depending on how buried your administrator's investment interface is. You will do it once, then it runs. Step 6. Start a receipt folder today. Create a folder, Google Drive, Dropbox, a dedicated album on your phone. Any qualifying medical expense you pay out of pocket from this point forward is a future tax-free withdrawal, right? You just have to keep the documentation. If you are not currently on an HDHP, look up your employer's plan options before your next open enrollment window. Run the premium comparison. Estimate your annual out-of-pocket exposure based on the last 2 years. If the math favors the HDHP, make the switch and open the HSA the day your new coverage begins. The pay stub has been arriving every 2 weeks, for years, sometimes decades. You've been reading one line on it, the number at the bottom right, the one that tells you how much arrived in your checking account. Everything above it, 8, 10, 12 other lines, is a compressed summary of every financial structure sitting between your gross income and your actual wealth. Some of those structures you have no control over. Some of them have defaults that are more convenient for the institution than for you. The HSA line is not fixed. The cash default is not mandatory. The investment feature is not hidden behind a wall. It's behind a tab. It has been inside your portal since the day you opened the account. Nobody told you about it because nobody was paid to tell you. The institution holding your balance was earning 4.5% on your cash. The HR representative covering benefits at orientation had 11 other slides to get through before noon. The paragraph that disclosed the investment feature was on page 14 of the account agreement you received in your welcome email and never opened. Now you know where the switch is. My name is Arthur. Subscribe if you want the next breakdown. I'll see you there.